Speaker of the day, Mr. Shailesh, Sheth, Vice President Chetan, Chirag Mehta, Member of the Indirect Taxation Committee, past presidents, seniors, professional and student friends. On behalf of the Bombay Chartered Accountants Society, I welcome you all to this lecture meeting on Model GST Law, Salient Features and Issues. BCAS arranges free public lecture meetings at least twice a month in addition to other professional educational activities on an ongoing basis. However, this is the fourth lecture meeting in this month. We had similar lecture meetings on ITR filing, one on audit finalization for the year ended 31st March 2016, and last week, and both were very well attended. Actually, people were standing all over the place. And the last meeting we had at our society's refurbished premises on Bankruptcy and Insolvency Code 2016, which was for the first time webcast live, and so that we could reach members wherever they are in for that particular lecture meeting. My name is Raman Jokhakar. I serve as the honorary president of the society, and I'm very happy to see this attendance and welcome all of you. The society was founded in 1949 as a voluntary not-for-profit organization and is located in the Churchgate area and has a learning center that can hold nearly 100 people in its hall and also houses a library. Through its 9 committees, the BCAS carries out numerous educational activities that benefit both the professionals and public at large. One of the main activities of the society has been its monthly journal, the BCA Journal, now in its 48th year of publication, and is regarded in high esteem for its analysis, updates and views, both by professionals and legal fraternity, and sometimes even by the regulators. In addition, the society arranges more than 100,000 hours of events such as the one on Finance Act 2016, which is going to happen on Friday, 2 days later at the society's premises. The BCAS also publishes books and referencer. The referencer, which was released a couple of weeks back in its 54th avatar. So friends, this society, like some of us here on the dais and some people I see here, is run by the volunteers which makes this society not only something where the members work for themselves alone, but it is a society where the members, its core committee members and the office bearers work not only for themselves but the society at large by running various programs like this one. Recently, we have just released, in fact today, those who are web subscribers, we have released a service tax referencer in an ebook format. So those who are members of web subscribers, you may want to check that out. It's a very interesting publication and a very, very handy tool which is not otherwise available. Also, last week we had a residential service course on service tax and VAT. Where we had promised that we'll start a group where people can post their queries and have discussions. So we have started a LinkedIn group today, and you may want to check out that page and be a part of it. Coming to the topic of the evening, and as the title suggests, salient features and issues. The model law released earlier this month is the next step in a much awaited business reform that seeks to deal with numerous issues that fragment a federal union like India. Presently, VAT is imposed on sale of goods at a state level and excise and service tax are levied by the federal government. And those who didn't know could have guessed that these laws do not really talk to one another. Now GST will change that. In simplistic terms, it will bring one law for manufacture and sale of goods and services, and hopefully unwrinkle numerous issues around the entire process. Therefore, this is not just a legal reform, but a business reform that aims to connect various aspects of businesses and bring them under one common umbrella of GST. At least That is what it's meant to be. Of course, we all know that due to one party opposing the GST, it's been getting delayed, and perhaps Chetan was telling me that maybe we need a referendum like the Brexit, whether we need GST or not, and get this thing moving this way or that way. As the title of the lecture meeting suggests, even a model law has issues. A model law is usually something that is near perfect, ideal, which should be an example. Although BCAs are trained in professional skepticism, yet even if one were to put all our skepticism aside and all our competence aside, the model law does have issues which definitely are avoidable. The document spans nearly 200 pages and is open to comments for eventual GST legislation. Considering the scattered framework of excise, VAT and service tax laws, the dodgy way they have evolved over the years, and some of which is outright obnoxious and distasteful, this GST paper does at least codify the legal frameworks. In accounting terms, I can say that GST is a contingency as of today, contingent upon the constitutional amendment passing out of Rajya Sabha in this monsoon session. The success of GST also depends on the government able to absorb the stakeholders' comments and listen to us in the final legislation that gets formed, and finally all the states adopting and enacting a model law that will be adopted and modeled in its fullest form at each state level. Of course, when all of these happen, then there is a chance of uniformity, consistency, and perhaps certainty that our country and our countrymen, and especially the businesses, are longing for, so that we can call ourselves a truly united market. GST in that sense is a test of a working federal democracy. As public accountants, this is a special time. Changes range from Companies Act, which happened in 2 years ago, the Bankruptcy Code, the Ind AS, and now the GST. This time can be called the monsoon for all the professionals in practice. In view of this, we are delighted to present this lecture meeting before you by none other than Advocate Mr. Shailesh Sheth. Mr. Sheth has been an old friend of BCAS and has presented papers at our offsite courses more than once. He is a regular faculty at numerous bodies, and I won't name them all. He writes a regular column in a popular Gujarati newspaper, a business newspaper, Vyapar, for several years now. He has experience of over 25 years and is in practice of indirect taxes, advisory, compliance, and litigation support in all the indirect taxes, excise, customs, service tax, state level VAT. He has dealt with a wide range of industry. He also serves as a member advisor on committees of trade and professional bodies. And to those who know him, he has incredible passion for music, amongst several other things like literature, and he sings really, really well. After knowing him since last 10 years now, I can confidently say that he can sing just as well as he would deliver today's talk, and perhaps that long too. Shailesh is a versatile and a fine human being. We are grateful to him that he has always been generous with his time for BCAS, and I would request Vice President Chetan to present a memento to him as a mark of our appreciation and regard. Friends, please join me in welcoming our speaker, Mr. Shailesh Sheth.
Thank you, Raman, for very kind and words. I hope I really deserve them. BC is my old friends. I wouldn't say president or committee members of the dais, on the dais, all dear friends, and also the friends who are today present in this auditorium. my sincere thanks to, I'm really sincerely grateful to BCAS for providing this opportunity to share my thoughts on this new animal which has been leased amongst the unsuspecting taxpayers on 14th June 2016. I was really puzzled when Govindji told me, Shailesh bhai, we want to arrange a public meeting, and this month itself, because believe me, generally I'm not given to express my personal feelings in the open. But when I read through the whole bill almost in the night of 14th itself, since then I am hardly able to really stabilize my mind. I have not gone mad, but not been able to. It's extremely difficult to control your emotions, disturbing emotions, once when we go through this so-called draft GST model law. As we progress in our discourse, we'll come to know that. But as is my favorite quote would say it all, Hugh McLennan, when he says that man is a thinking animal, a talking animal, a tool-making animal, a political animal, a building animal, a fantasizing animal, but in the twilight of civilization, he is chiefly a tax-paying animal. We are all destined to be tax-paying animals till we breathe our last. Nearly 2,500 years back, the ancient Greek philosopher Heraclitus remarked, change is the only constant in the life of a human being. After nearly 2,200 years, Benjamin Franklin sardonically and somewhat sarcastically said that death and taxes are the only constants in the life of a human being. Everything else changes. It's very ironical that death is keeping the company, tax is keeping that company with death. The meaning, the message is very clear. The burden of tax would remain with a human being so long he lives. And to get rid of the burden for once for all is to really die fully and completely. Then one is really relieved of that burden of tax. And since change is also constant in the life of a human being, it is equally true that no taxation policy can remain static. Though the tax policy should be stable, but it cannot remain static. It has to be evolving with the changing times, fine-tuning itself with the economic, political, social realities, not to say anything more. This is happening world over. It is in this context probably one may have to see that the goods and services tax, the GST, what we have been talking about, discussing about in these countries in almost now 15 years. That why? Because the one question, why GST, is uppermost on the minds of the trade and industry and the taxpayers. Why can't we really fine-tune and modify our the existing indirect taxation laws both at the central level and the state level? That is a question uppermost in the mind of the people. The answers are many. Today is not the topic. So I'll proceed on the basis that GST is the need of the hour. It is a fairly young tax compared to any other tax. First time it was introduced in 1948 in Brazil, then 1967 by France, 1967 by Brazil, and since then nearly 165 countries of the world are GST compliant or VAT compliant, as is also known all over the world. The notable exception is obviously USA, where there is a retail sales tax. The latest interest in the GST club is Malaysia, which adopted GST from 1st April 2015. And now it is knocking at our door. We know that 122nd, Constitution 122nd Amendment Bill, which is the precursor to the, without which the GST cannot see the light of the day. That is already in Rajya Sabha. 18 July will probably see the monsoon session when it begins. It will, maybe probably it may see some fireworks over everyone. But emboldened by the better than expected show in the recent assembly elections, open support extended by TMC and CPIM, and the changing equations in the Rajya Sabha, it appears that the NDA government is fully confident of passing the constitutional amendment bill in the coming monsoon session. And therefore, there have been now firm overtures on part of the Honorable Finance Minister about the GST becoming a reality from 1st April 2017. But is it so? I'll just leave this question here. One, the two things happened. 14th and 15th June, there were in Kolkata, there were an empowered committee of state finance ministers who have been working on GST model from the day one. They have had a 2 days meet, and on 14th June, somewhere in the afternoon, there came the news that TMC has agreed, all parties have agreed. AIADMK has not given open support, but one can almost take it for granted. Even absenteeism is also a consent. So we will see something happening in RS. So that all parties have agreed, and GST government is confident of introducing this new regime from 1st April 2017. And simultaneously, within hardly an hour or so, GST model law was released in the public domain, inviting the suggestions, comments, reactions from all the stakeholders. That happened in the afternoon of the 14th June 2016. And it has since then sort of a frenzy created, has gripped the entire nation. The imagination of the nation is veered towards this one single event. Slightly, it was diluted because of the Brexit. That was a different matter. It came as a welcome change almost in a span of 15 days. So, and today, without going into, I'll presume that we will have, all of us who are present here, most of them would have an idea about the fundamentals of GST which is being proposed in this country, the dual structure. Only three things to be remembered, because we are only on the model law, which is quite a long law. Obviously, we are not discussing all the provisions. It is a dual structure because of the federal structure, the federal character of India, one. Secondly, it will have three major components: CGST, Central GST, State GST, and IGST, Integrated GST, on the interstate sales of supplies, interstate supplies of goods and services. It will be levied concurrently on the same tax base, CGST and IGST, SGST, and IGST will be levied on the interstate supplies. It is expected to subsume all the indirect taxes, including cesses and surcharge, which are being levied at the central level and at the state level, including the taxes which are being levied by the local authority like LBT, entry tax, or octroi, etc. These are all expected to be subsumed in the GST as a whole. Taking this as a base, let us see that how the GST draft law is really panning out. But friends, the question which I posed a couple of minutes ago is, are we really ready to go? My personal understanding is that none of the stakeholders, center, states, state revenue officials, trade and industry, not to speak of tax professionals themselves, I am included, are really ready, are geared up for this gargantuan change which is expected to take up. As Raman has just said, GST, don't mistake GST for a tax reform. It is an outright business reform. It will change the way the business is carried on in this country by everybody, be it a manufacturer, service provider, or a person situated in the distributive trade like stockist, wholesaler, retailer, or whomsoever it may be. It will affect the consumers also in an indirect way, which the indirect tax is all about. But the life will not be the same again in this country once the GST is introduced. That much for sure. Effect could be negligible, effect could be major, effect could be positive, it could be negative, whatever it may be. It will all depend upon the status of the person from the taxation perspective. But no one will be spared of this impact of GST. The first is obviously at the same time, GSTN, the IT platform on which they hinges the entire success of implementation of smooth GST itself is probably hard in place to really ensure a smooth transition from the existing taxation regime at central and state level to this, the all over India, this GST regime, the new reform. It is not an incremental tax. It is a transformational tax. Without any hesitation, I can call it, and I'm used to call it, I call it a taxplosion. GST is a taxplosion in making. And when we try to meet it without being prepared for it, like just as happens in any explosion, we may be blasted away. It is not something which can be taken simply lightly. Having said so, coming back to GST model law, Ottawa Taxation Framework Policy, working as a part of the OECD guidelines on so many things, I'm not going into the details, had released a paper in the context of the salient requirements or the features of any sound taxation policy. This was actually released in the context of e-commerce, but it is equally good for anything, for any taxation policy. The 5 characteristics which the framework has emphasized upon were that is called the principles of taxation policy. The first is neutrality. Neutrality is one of the outstanding feature of GST. I'm just mentioning it. We are not going into detail. Why? Because I intend to connect it up at a later on some of the provisions on the model law. So neutrality, efficiency, certainty and simplicity, effectiveness and fairness and flexibility. It is against this backdrop, it is on the touchstones of these 5 requirements of the Ottawa Framework Policy as defined as the principles of taxation policy, one may have to see that where GST model law stands. 1. Let us see the structure of this. Entire GST model law is comprising of 25 chapters, 184 sections, which includes certain sections which are affixed with 163A, 163B, 163C. Section 4 is appearing twice because of to take care of the GST. Other sections from 79 to 83 relating to appeals are also appearing twice because of the SGST. This is a common law. So there are 184 sections and 4 schedules. Simultaneously, there is the GST determination of value of supplies. That evaluation rules draft have also been released. And the third draft which has been released is that is of Integrated GST Act 2016. These 3 have been put into the public domain. Some of you might be aware of that in September 2015, Subcommittee 2, there were 2 subcommittees appointed by Honorable Finance Minister to work upon the various aspects of the GST, one leading by none other than Chief Economic Advisor, Mr. Aravinda Subramaniam. In this subcommittee, there was a draft GST law which was already prepared in September 2015, which was actually never put into the public domain for whatsoever reason, though probably, as rumor has it, it was selectively leaked to certain people, to certain states. That September 2015 GST paper had 20 chapters as against the current 25 chapters. It had 131 sections as against the present 184 sections. It had 3 schedules as against the present 4 schedules. It is now available, so please don't be under that impression that I was one of the beneficiary of this leaked draft. So you can visit the Finance Minister's site and you will get it. There is certain interesting comparison can be made, but that is beside the point. Now, there are 109 definitions as against 77 definitions in the EC's draft law, September 2015 law, 109 definitions in the current law. Out of these, that 77 definitions which were there, 9 more definitions had been suggested by subcommittee 2 to be included. They have all been included. So altogether there are 86 definitions in the first draft as against 109 definitions which they have added. What is important is also that out of these 109 definitions, 29 definitions have been adopted directly from the existing central and state laws or acts, either bodily lifted or they are patterned on the same with some minor modifications. 29 definitions, 15 from Finance Act 1994 governing service tax, 3 from place of provision of supply rules, service rules, 2 from Senvet credit rules, 1 from Central Excise Act, 6 from Maharashtra VAT Act, and 1 from service tax rules. These are the 29 definitions which are almost patterned on or bodily lifted from these existing enactments. Another interesting point, and here comes the crux. There are three expressions which are figuring into the entire GST model law time and again. One of the most obnoxious and notorious expressions ever used, but you can't live without it, and that is as may be prescribed. We have seen the fate of Companies Act 1956 and now Companies Act 2013. I think practically every other section or every section has as may be prescribed. So as may be prescribed has been used. There are 184 sections, friends, and it has been used 128 times in the entire model law. As may be notified has been used 8 times, and on the recommendation of the council, GST council, which is a constitutional authority, on the recommendation of the council, expression has been used 16 times. This probably tells us the shape of the things to come. One thing is very clear, not only the parent act, we will have probably equally a long winding, never ending rules also in offing when GST comes into picture. As it is, GST is going to be highly compliance-driven law. But with the way the things are, the various sections, the various provisions at every grassroots level where they have used this expression is extremely debatable, and disturbing. And the other part is now, so this is the structure. We'll now go into certain specific provisions and certain highly, but if I have to sum up my personal feeling as far as this law is concerned, when I went through and again went through again and again, is a sheer sense of disbelief, disappointment, and deja vu really grips the mind. It is highly disturbing, distressing, disappointing, and diabolical in design and purpose. It appears that the entire law drafting, or the substantial part of the law, the drafting of the law, has been entirely hijacked by the state-weight authorities, with the central revenue officials having hardly played any role into that, or if at all they have been allowed to play, it is like a second fiddle. And one may consider themselves lucky, even they got the chance to play second fiddle. What transpired, what went into this, why, how, behind the curtain, we don't want to get into that, but this is the impression as a tax professional or as a citizen you get. You read it at either way. This is the first impression you get it. It was expected to be innovative. It was expected to be something out of box. Instead of that, this is nothing but largely a masala khichdi cooked out of the existing central and state level laws. The recipe is bad, the cooking is worst. And as the internationally acclaimed VAT experts, Mr. McClure and Brendan and McClure have stated, if you do not get in GST, if you do not get the things right at the inception stage, then it is very difficult to really change the law or change the matter at a later point of time. Take our home kitchen also. Once the food is badly cooked, you can't go on changing it. You can't do much about it. You may, here and there, you may actually try to salvage the situation by tweaking the pro. But beyond that, nothing can be done. And as Plato has remarked very wisely, that a king should rule a kingdom like cooking a fish. If you meddle it with too much time and again, then it will spoil and the fish will become unedible. This appears to be the shape of the things to come. I shudder at the thought that if this is the draft law, and if without making some minor changes here and there, if this is going to be really introduced in this country, what would be the fate? I'm tempted to say, and I'm pained to say also, if GST stands for goods and services tax, then if this is the shape of the things to come, then GST may as well stand for God may save the taxpayers. G for goods, S for save, and T for taxpayers. Coming to definition clause. Section 1, which speaks about the jurisdiction of the entire law. Interestingly, GST Act is going to extend to whole of India. The present Finance Act does not extend to Jammu and Kashmir. But GST Act is going to extend to whole of India. This is a very interesting and significant provision, and it can be an independent subject of the discussion, that if it is extended to whole of Jammu and Kashmir as well as compared to the current Finance Act, then what could be the scenario as far as the supplies to and from Jammu and Kashmir are concerned. Totally. But we leave it at that today. Then Section 2 is the definition clause, which, as I said, has 109th definition. Certain crucial terms have been defined in this. Certain crucial terms or expressions are not even defined in this, which would need. Will it be defined under rules? We'll have to wait and see. Quite many expressions which have been defined, which needs clear definition. Yeah. But let us take the first one. I'm taking some 3-4 major definitions, considering the today's the theme of the subject, and that is Section 2, subsection 61, defining the term supply, and it says supply has the meaning assigned to it under Section 3 of the Act. Act here means GST Act. It has a meaning assigned to it under Section 3 of the Act. This is, friends, we must be now aware that as per the constitutional mandate, as per the GST design world over followed, GST, the taxable event is of supply of goods and services. The present day taxable events under the indirect taxation laws, that is manufacture for the levy of excise, transfer of ownership in goods for the levy of sales tax, provision of taxable service for the levy of service tax, and crossing of the Indian territorial waters for the levy of import duty or export duty under the customs purposes. These 4 taxable events would become overnight redundant and irrelevant once GST is introduced. Overnight. We are all used to live with these taxable events, determining the taxable events for almost now decades long, anywhere from 10 years to 50 years. Overnight, all these taxable events would be relegated to the past, and the taxable event for GST will be supply of services or goods. Supply being the word of the wider connotation, even then sale or removal or disposal, or one can only imagine that the swipe or the wide coverage which this particular taxable event can take. The one. Section 3 defines supply in an inclusive manner, and apparently it is very wide in the scope. And here starts the first problem. Since supply is the pivotal around which the whole GST law will be actually functioning, it need to have absolutely clear definition. The expression has to be definitive. It can't be inclusive. But Section 3 starts, subsection 1, supply includes, then ABC, all forms of supply of goods and services in any manner, sale, barter, exchange, disposal, etc. etc. Barter, exchange, everything is within the scope of supply. Now, if it starts with includes, and here is my first objection to that. How can such an important expression can be defined straightway in an inclusive manner? Why can't the draftman use the word supply means and includes? It has to be definitive. The overhang of the definition of manufacture is clearly visible, can clearly be seen as far as the definition of supply is concerned. Section 2F of Central Excise Act defines the term manufacture in an inclusive manner when it says manufacture includes any process incidental or ancillary to the completion of the manufactured product, and then there is a deemed manufacture concept. That definition, probably we can pardon the draftman who has done this job nearly 75 years back, because they may not have been able to visualize the pain which the coming generation will suffer in posterity because of this way, the manner in which this definition has been coined. Manufacture includes. Requiring time and again the Honorable Apex Court to step in and decide what is manufacture. Even today, despite all the the celebrity pronouncements of the apex court, right from DCM case, South Bihar Sugar Mill case, Moti Laminates case, Bor Industries case, Pawan Biscuits case, Parle Products case. In spite of that, the innovative brains of the revenue officers keep on coming with the new ideas as far as the term manufacture is concerned, requiring ultimately the Supreme Court to decide what is manufacture and what is not manufacture. We have been fighting this even today. And if we do the same thing for this all-important expression supply, in the context of the GST model law, the same fate is likely to be actually visited for these, and again for another few generations, we will go on fighting what is supply and what is not supply. Take another federal example, on the global GST map, Canada law, it is also a federal structure. We have picked up lot many things from Canada, Australia, UK, European Union, to some extent New Zealand, and obviously to some extent Malaysia also, our neighbor country. Love thy neighbor. So the Canada, where it says the supply means and includes. Such definitive expression is available for the supply even in the European Year 6 Directive, 1973, even in the revised directive. UK VAT Act again speaks about the same manner. Supply means. Even a country like, many of you might not even heard of the name of that country, a country as tiny as Botswana has also a much specific definition of supply than our present form. The issue is that ICI's draft law defined supply means all forms of supply. Coming to the other parties, the supply made with or without consideration. It means now there is not likely to be any free lunch. The free supplies is also expected to come within the purview of the levy. We have been jokingly said no free lunch, but now be prepared that there is not going to be any free lunch. At least not from the revenue perspective. You may give free, but I am going to tax you. The Section 3, subsection 1 of ICI's draft law talked about all forms of supply made or agreed to be made, including importation of service for a consideration. That was the ICI's draft law, for a consideration. There was no mention about the without, made with or without consideration. That is stepped into the latest draft. Section 3, subsection 2, subsection B speaks, supply includes importation of service, whether or not for consideration, whether or not for a consideration, and whether or not in the course or furtherance of business. Two aspects of this. Importation of service with or without consideration. That is also coming into it. So if my relative of my brother situated outside India provides me any service without any consideration, am I supposed to pay GST under reverse charge? If it is in the course of furtherance of business, made with or without consideration, in the course of, the other part is this expression in the course or furtherance of. You see the draftman, there is a sheer casualness and the carelessness as far as the drafting is concerned. There cannot be more clumsy way of drafting the entire law. It is clumsy, casual and callous. The in furtherance or in course or furtherance. There is nothing in course of or in furtherance of. As if of will qualify both the words. So they are practically tired of using of at both the places. It is in course, in the course or furtherance of. And it makes such a horrible reading. Anyway, that's the grammar part. Now, importation. The other part is, it says, going further, it says, subsection 2 says, subsection 3 shall include the matters listed in Schedule 1, made or agreed to be made without consideration. If you see Schedule 1, there are 4 schedules as I mentioned. The title of the schedule is Matters to be treated as without consideration. Which are? The Parent Act provision says matters listed in Schedule 1 made or agreed to be made without consideration. You see the conflict. If it is something is already made with or without consideration, then where is the need for the deeming provision? With the schedule says. matter to be treated as made without consideration. And the section says the matters listed in Schedule 1 made or agreed to be made without consideration. And since this is a deeming fiction, does that mean the items which are listed there are basically in relation to the retention of the asset or the closure of the business, etc.? If you see, there are two. The original Schedule 1 of the EC's draft law of September 2015 at serial number 4 spoke about self-supply of service, goods or services. That was item serial number 4, self-supply of goods or services. Now, that is not finding mention in the Schedule 1. Now, entry at serial number 5 says here that it will be any supply made by a taxable person to another taxable person or non-taxable person in the course or furtherance of business. Now, I have still not been able to fathom what is the meaning of this. Friends, remember, we are talking about Schedule 1, matters to be deemed to be treated as without consideration, where artificially consideration may be determined by the revenue officer in terms of the valuation rules. If any supply made by a taxable person to another taxable person or non-taxable person, then everything is deemed to be without consideration. What they want to convey, I'm totally lost on this. The other part is, if these are deemed to be, these 5 matters are deemed to be tested, considered to be without consideration, does that mean that even if there is a consideration, it will be discarded and artificially the consideration will be determined? If there is a retention of the assets or the disposal of assets or anything, whatever the items which are mentioned there, if there is a genuine consideration, but these are to be deemed as a without consideration, does that mean that it will be artificially determined? The question is begging for the answer. I am just searching for it. The other part is about that non-taxable person has been defined in a different manner. Taxable person has been defined by section 2 subsection 96, and the non-taxable person has not been defined. However, in the context of section 9 subsection 3, the people who are required to obtain the registration, subsection 3 says that following persons shall not be treated as person liable to pay tax. There are 3 persons who are actually mentioned under that category who are treated as non-taxable person. But non-taxable person per se has not been defined. The other case is place of business. Section 2 subsection 75 also starts with the inclusive part. Place of business includes where there is a fixed place of business or all the records are maintained, etc. Coming to why can't we have that permanent establishment concept which is well so settled in the context of income tax law, international taxation, and world over GST compliant countries? They have actually adopted the permanent establishment concept. The permanent establishment concept is entirely missing in the GST model law. They are talking about fixed establishment. There is no mention about permanent establishment, no definition, nothing. The other definition is of securities. Securities is not defined. It is defined today in Finance Act by the section 2 subsection 65B 25 and the 65B 43. Because today the goods definition which is given in the Finance Act 1994 at subsection 25, goods means so and includes securities. Security is defined under subsection 43, means having the meaning assigned to it under section 2H of Securities Contract and Regulation Act. That is the current definition. The term security is not defined, however it is appearing in the goods definition under the draft model law at section 2 subsection 48. The explanation says, explanation to this section 2 subsection 48 of the draft law, model law, which defines goods, the explanation says it excludes intangible property, and I'll stop there. It excludes intangible property. Now, intangible property has been defined under section 2 subsection 59 as any property other than tangible property. Tangible property has been defined under section 2 subsection 93 as a property means any property that can be touched or felt. So something that can be touched or felt is tangible property. Something which cannot be touched or felt is intangible property. I'm just reminded of that blockbuster song, since Raman has mentioned about Khamoshi. Raman, I'm not going to sing it, but the Khamoshi. हमने देखी है उन आंखों की महकती खुशबू, हाथ से छू के इसे रिश्ते का इल्जाम न दो, सिर्फ एहसास करो ये रूह से महसूस करो, प्यार को प्यार ही रहने दो, कोई नाम न दो. So this touched or felt, right? Now that is tangible property that can be touched. Section 2 subsection 88 defines the term service means anything other than goods. Constitutional definition, anything other than goods, forget about the grammar part. The explanation says and includes intangible property. In other words, services includes intangible property. We will have that probably welcome change that as far as the taxability of the intangible, whether VAT will be applicable or service tax will be applicable, that will be probably the thing of the past because it will be treated as a supply of service. But since the services include intangible property, intangible means something that property that cannot be touched or felt. Securities in its dematerialized form is tangible or intangible. Security is covered by the definition of goods. We don't have the physical sales certificates now. So it can neither be touched nor can be felt, except as a ownership. I have this investment. So if it is not can be, so if it is intangible, it will fall under service. We will again have that perennial question like software. Software is goods or software is service. Another addition to the list, security is goods or security is service. There is already a chaos from a different angle that the security is being covered under the goods, there will be a levy of GST on it. Already 0.1% STT is being paid on it. Hopefully this will be exempted, that's a different matter. This becomes important in the context of two subsequent developments if at all it takes place. If there is a differential GST tax rate regime for goods and services, number one, and secondly from the place of provision of supply perspective. Because POPS, place of provision of supply, place of supply rules for goods and services are entirely distinct. So first is supply, which is a problematic definition. Software, we are already facing the problem. Ironically, software problem may get solved, but security may get included. Another one is composite supply. Section 2 subsection 27 speaks about composite supply, and it says it means it is definite, explicit, clear. Composite supply means where the supply consists of two or more goods or two or more services or one or more goods or services, and which cannot be segregated. I wonder if my supply comprises of two types of goods only, whatever it may be, how can be treated as a composite supply? It is a single supply of goods comprising of two types of goods. It is a supply of goods. It is not a composite supply. How can there be because goods by itself is a one single element. It is not comprising of two elements. Unlike the works contract where there is a labor, service and goods both are involved. One can understand composite supply of goods and services. How can there be a composite supply of two goods or more goods or two services or more services? No, I mean, I'm asking to myself, not the answer, yes. Anyway, something which is puzzling, yes. But anyway, thanks. The question here is, so therefore, this is one. And composite supply having been defined, the expression is not appearing in anywhere in 184 sections, nor in the schedule, in the entire draft model law. That expression is not appearing anywhere. We will have to see whether it becomes part of the rule somewhere for some reason. This one. The third one is consideration. Section 65B 44 that defines services today as any activity carried on by a person for another person for a consideration and includes and excludes, etc., etc. For a consideration. The term consideration has not been defined, but consideration is a quid pro quo today for the levy of the service tax in whatever form it may be, money, kind or otherwise, except free supply. Now that consideration, obviously we are adopting the definition of under section 2D under the Indian Contract Act 1872. Consideration has been defined in a very exhaustive manner. However, I'm not going in that part of the definition. Main part, there is a proviso which says refundable deposit or not, shall also be treated as a part, or shall not be treated as a part of the consideration unless it is adjusted against the supplies. So refundable deposit or not. Now or not, presume either non-refundable deposit or refundable deposit, something which is non-refundable in the first instance, later on even adjusted against the supplies, it will be treated as a part of the consideration. The question here is, what if I take the refundable deposit, but I never actually adjust it against any supplies which I make, and I keep it in my books of accounts year after year after year? What if I write it off for the purpose of income tax and then pay income tax on it, but never raise the bill? I or my dear friend Raman, we give the services to the client and we say that give us refundable deposit, but not against any services. At the end of the year or after 2 years, that refundable deposit, I do not adjust it. I actually write it off in my books of account and then I pay income tax on it, right? But I'm not adjusting again. And who can prove that I have provided services and against that refundable deposit has been adjusted? The point is, it's a sideline on the point. The point here is, if refundable deposit later on adjusted against the supplies, whether what will be the date for the purpose of the payment of GST? Will it be the date of adjustment or will it be the date of the receipt of the refund? Somewhere down the line, they have actually confused themselves between advance and deposit. The fourth one is all important capital goods input and input services. I'm shocked when I saw these three expressions in the draft model law. Standard Credit Rules 2004, Rule 2A defines capital goods, Rule 2K defines input, Rule 2L defines input services. All the three definitions, all that three ever-present elements means, includes, excludes, coupled with explanations which never explains anything, and the definition is complete. Now, the entire definition has been of capital goods has been lifted from Rule 2A of CCR into Section 220 capital goods, bodily. And they are also saying that it says, you know that capital goods for the purpose of standard credit are defined by description, either description or by chapter or by heading. These all chapters and headings are Central Excise Tariff Act 1985. They have kept it actually at it, right? And they say, okay, we are going to refer to CETA only. There is an input definition which says input does not include capital goods. It excludes capital goods. The point here is that if ITC, input tax credit under GST regime, is expected to be a regime where there will be a flawless, seamless credit available on all procurement of inputs or goods or services, why do we have this type of distinction of capital goods input and input services, particularly capital goods and input? They are also defining capital asset at Section 2, subsection 19. Capital asset is having the meaning assigned to it, I think under Section 2, subsection 14 of the Income Tax Act 1963. The only difference is, for the purpose of GST, capital asset will not include jewelry for the personal use or any property not associated with the business. It will be outside, which income tax does not distinguish. It includes everything, right? So the question here is that the first question, which is a very forbidding coming to the mind, and today the 50% regime, 50% in the date of receipt of the capital goods, another 50% after next year, in the next year, whether the staggering credit regime will continue under under the GST also for the purpose of capital goods. Why this distinction? Why can't they simply stick to capital asset? A well-defined, well-understood, well-analyzed and well-settled concept under income tax. We have as early as in Rama Multitax, somewhere in 1990s, that what is capital asset for the purpose of income tax is not a capital goods for the purpose of standard credit. So are we again going to witness this staggering credit regime as far as the capital goods is concerned? The other part is the next is probably they have defined it for the purpose of reversal of credit. Let us give them the credit. Section 16 speaks about the reversal of credit. Subsection 14 says that when any capital goods on which credit is taken, the credit shall be reduced by percentage point. Today it is 2.5%. Under Rule 3, Sub-Rule 5, if it is removed as such without use, then whatever credit taken, if it is removed 5A, Sub-Rule 5A, Rule 3, CCR, then it is reduced by the percentage points. Two things are here notable. You see the bad drafting. They say that on any capital goods on which credit has been taken, credit shall be reversed by reducing the percentage point. But at which stage? There is no mention about the removal in the entire section, subsection 14. It should be credit which has been taken if they are removed after use or before use. Secondly, they talk about reducing it by percentage point. What if the capital goods are removed as such and without any use? Today the clear distinction has been made. That distinction is missing under section 16, subsection 14, as far as the reversal of credit is concerned. Next is section 2, subsection 43, 44, 51 and 52. Export of goods, export of services, import of goods, import of services. These four expressions defined under 44, 40, 43, 44. Again you see the carelessness. Export of goods has been defined as export of goods means taking out of India. What, Mr. Sheth? Import of goods is defined the bringing within India. What? No mention about that. They have not even cared to say export of goods means the taking out any goods outside India. Taking out of India, it is left to your imagination, whatever you want to take out. Voltaire was not wrong when he said, let all laws be uniform, clear. To interpret the laws is almost always to corrupt them. When you are interpreting the law, you are corrupting the law. The law itself, it is in a raw form, should be clear and absolutely definite, requiring minimal interpretation if ever. Other part is export of services has been defined under 44, subclause 44. It is practically the replica of Rule 6A, capital A of the service tax rules. Export of service, 6 conditions to be notified. It is actually directly reposted there. The thing is, one of the conditions is foreign exchange. The payment should be received in convertible foreign exchange. Why this obsession with the convertible foreign exchange? What is the need for that? Why can't we think like a developed country? In excise and VAT, there is no need for the foreign exchange payment to come against exports to get the export benefit today. Why do I need it for services? What is the need for that? What will be the relevance of the convertible foreign exchange when the full convertible capital convertibility will come? Will it be of any relevance at all? But old habits die hard. We take fancy to certain things and we stick to it for eternity. This is how the draftman works. Import of services, subclause D says of that clause, import of services, that service provider and service recipient are not merely establishments of a distinct person. It means if they are establishment of a distinct person, then it is not an import of service. Absolutely goof up. And then the explanation 1 says, it is directly saying, actually it is trying to salvage the situation by saying that 2 or more establishment, one situated in India and another outside India, of a person shall be treated as the establishment of distinct person. And we know that even from the branch or head office from outside India, if it comes something to India by way of services, I am liable to pay. That is what they wanted to convey. Read clause D along with explanation 1 to section 2, subsection 52, and the clear conflict is there. Maybe it is a slip of pen. We can grant them. Next, the restriction on credit, section 16, subsection 9, and here comes the crux again. ITC, as I said, was expected, GST was expected to be a regime where there will be a uninterrupted, flowless, seamless credit will be available. The hopes are entirely dashed to ashes. Apart from subsection 9 of section 69, list out on what credit will not be available. The exclusion part of the Rule 2L defining the term input service, which does not allow the credit on the certain services like outdoor catering or club membership or the insurance or such hotel expenses for the personal consumption of an employee, entirely has been reproduced under the exclusion clause for the purpose of taking the credit, no credit available. We continue with that. Very recently, 15 days back, Chennai bench of the appellate tribunal has held that if the employee insurance is taken for the employees, it cannot be treated for his personal use or consumption, credit cannot be denied. This is the decision after the new amended definition which came into force from 1/4/2011, when they messed up the whole design of the input service definition. Again, we have to start with whether it is for the personal consumption or not. Why can't they say that anything which is allowable as a business expenditure for the purposes of income tax should also be treated as a creditable supplies of the goods or services? Why can't they do that? The IT is allowing you as a business expenditure, I will allow you the credit on it. There are two other clauses, clause C and D of subsection 9, section 16, which speaks about the sum and substance of that. Without going into the details, if any goods or services which are used for the purpose of foundation, the factory shed construction or factory, any such or building, etc., as a builder or as an entrepreneur setting up the factory, credit is not available. A big blow, absolutely big blow, especially for the manufacturers who are setting up the factory, no credit available. What it says is, if any goods which are used for the purpose which results into the construction of an immobile property other than plant and machinery. So plant and machinery will be the other than. But then again, there are two clauses. But if I am creating some shed or any such civil construction or builder for building purpose, the credit will not. The real estate will have something to worry about. The other part is, and this is again, and this probably kills the whole process, and that is ITC will be, ITC means input tax credit, will be allowed to the recipient of the services or goods only and only if the supplier has deposited the tax with the government. This was on the cards, nobody paid the attention to it. This was on the cards since May 2015. In certain quarters, this was very hotly debated and discussed. Okay, this is what they are proposing, the design of the things to come. Fine, you need to safeguard the revenue interest, particularly because of the bogus cases, invoices. In excise, day in, day night, we are fighting the cases where the credit has been taken on the fake invoices or bogus invoices. Invoices, either non-existent suppliers or the invoices where the goods are not coming, or where the invoices come from one place, so the supplies come from another place, and both are getting married in the factory of the manufacturer. And the manufacturer taking credit on it. But nowhere, at no point of time, government has thought of mercifully to deny the credit if the supplier has not paid. At least not law, it is left to the interpretation, okay, whether credit is available or not on fake invoice, limitation and all. In service tax also, the restriction today, subs rule 7 of the rule, Senate credit rules, rule 4, sub rule 7, that credit is available on accrual provided you make the payment within 3 months. There is no condition that unless the service provider makes the payment of the tax which is paid to him, you cannot take the credit. Or later on, if he runs away, you cannot be, the credit will be reversed. That law was never there. This is the outcome of the VAT provisions. That's why in beginning I said the entire law appears to have been hijacked by the VAT authority. They are talking about matching the invoices on the GST end. Look into the legal aspects and the technical. First of all, legal aspect. Nowhere in the GST compliant world, nowhere in the world, the credit is denied to the recipient of the supplies on the ground that the supplier has not paid the tax. So long as the recipient has discharged its liability and paid the tax which is charged to him on an invoice, nowhere in the world the credit is denied. Sijbrand Notion, Netherlands internationally acclaimed VAT expert, when this was being discussed, when he was asked, he without any unhesitatingly said that this is going to be a retrograde step. He further said that two countries, BRICS countries had tried this, matching the invoices. Two countries had tried, China and Brazil, and they failed. And they have abandoned the idea. Today, European Union is losing about 100 billion US dollar because of the mismatching of the invoices. And most of them they have found mostly because of the technical glitches and errors. What we are actually experiencing in our TDS in income tax. Credit being not given because of the TDS certificate not matching or not coming or not being updated. Isn't it likely, or is it for sure, that the same fate will await when you talk about the matching of the invoices? Take the credit now, file the inward supply return, outward supply return, two returns to be filed, then file consolidated return, supplier will file, recipient will file, matching will be done by the system will decide what is the credit available to you and what is your liability for the period. And everything to be done within from 15th to 20th will come to the return date. And then you decide. System will only tell you what is the total quantum of credit available and whether any additional tax due is payable or not. System will not tell you what a rule 6, present rule 6, apportioning the credit between exempted activity and taxable activity. The same same provision obviously will continue in GST also. System will not tell you whether it carries any discrepancies. Supplier's invoices is carrying any discrepancies or not. System will not tell you that. But if supplier has made any mistake and he is for any reason either invoice does not match or the tax has not been paid by him, then next return credit will be denied to you. You will have to reverse it with interest. So a taxpayer will not only have to see that he complies with the law, he will also have to see that his suppliers also comply with the law throughout the country, whomsoever may be there. They are maintaining proper records, they are filing proper returns, they are actually discharging the tax liability in time. They have to ensure that the pilot project which was actually the brainchild here in Maharashtra government, and I understand April they tried it, all the returns which were filed manually or otherwise system normal, they have been actually said, okay, now you file under the new system, and the thing has collapsed. And government has no revenue as of now. This is at the state level. SAP may be capable of, technically. I call SAP, actually SAP is the correct name. It is SAP only. And once it is around your neck, very difficult to, unless you have very able Madari. So the question here is, friend, whether the draftmen or the policy makers have thought of that what is going to be the volume of the invoices throughout the country, which is going to be handled by the ICT network or the GSTN network. It could be billions of invoices a year. Have they visited China and Brazil and tried to find out why it failed and why they abandoned the whole idea of matching the invoices? Did they try that? This is nothing but, I'm sorry to say, it is a cruel joke on the taxpayers of this country. Nothing less than cruel joke on the taxpayers. The entire thing which is being envisaged as of now, we will have probably the economy of unregistered dealers. Composition scheme 50 lakh, threshold exemption 10 lakh, Northeast state 5 lakh. But a semi-literate or illiterate dealer is expected to upload the returns, inward supplies, outward supplies, consolidated supplies, returns on his system How many of them will be able to really afford the cost of the compliance and the transaction cost? Somehow or other they will manage. In this country, everybody manages everything. Somehow or other they will manage to remain within the outside the net at whatever price, with a telling impact on the stamp duty, income tax, or whatever it may be. Are we looking forward to this? The point is, invoice in this country we believe, but it is world over. Invoice is a sellable commodity in this country. Always. One can purchase invoice, one can sell invoice. If the government finds out some way of putting the tax on the invoice, purchase and sale of invoice, probably they would not need any other tax. So, but are you punishing the wrongdoing? Are you punishing the wrongdoer? Or are you punishing the innocent, the recipient? It's a different matter. Some stray cases, both could be in hands in gloves. I'm not going into that. How many are resorting to such type of invoicing, buying invoices? So instead of you want to punish wrongdoing, and in the process you are not bothered about whether you are punishing the wrongdoer or whether you are punishing the innocent recipient of the supply. Instead of going after the missing dealer, you are punishing, you are catching hold of, you are going after the dealer who is before you. In our Gujarati we have that proverb. Those who are in Gujarati would clearly understand. And this is what defines the taxation policies in country, and that is Chinde Chaido e Chor. There are 10 commandments of Moses. A taxpayer in this country should actually always remember the 11th commandment, which is unwritten, and that is, thou shalt not be caught. You should not be caught. And this, beyond this, actually there is, one would stop like not going further. The ITC. Going back to the value, the transactions about, I have not been able to really come out with a very firm conclusion that where do I pay my GST? How and where? There are some vague references under section 5A of IGST Act, which I am finding, but from where? This is a destination-based consumption tax. Where do I tax my? There are no clear provisions which tells me that at this point, in this state, in this manner, on this transaction, you have to pay tax from here. It does not even tell me that. Bill to ship to. There is a vague reference under section 5 of Integrated GST Act, subsection 2. Bill to ship to. It does not even cover the situation. Suppose a service provider, a big accounting network firm having offices all over India, the Bangalore office of that accounting network provides the services to a customer in Bangalore for which the bill is raised from Delhi. Is it an interstate supply or not? If I sitting in Maharashtra, I tell my Gujarat supplier to supply the goods directly to Karnataka and raise the bill on me, or I am in Maharashtra, my supplier is in Maharashtra, I buy goods from him, asking him to supply the goods directly to Tamil Nadu, bill to ship to. What happens? I ask Tamil Nadu, my supplier, to supply the goods in Maharashtra to my buyer, and I am also in Maharashtra. Is it an interstate transaction or is it an intrastate transaction? This also becomes important. I'll just connect it that point over here. Section 53, which speaks about the refund of tax if it is wrongly paid. Then, if a particular transaction has been treated as an intrastate, later on proved to be interstate, and the taxpayer might have paid IGST, then he will be required to pay CGST and SGST with interest, whatever, because he has not paid it wrongly, and for IGST which he has already paid, the refund will be subject to unjust enrichment under section 38. So I have it both the ways. That anonymous gentleman was not correct or not wrong when he said, when he says that everybody works for the government these days, either on their payroll or on their tax roll. Either we are taxpayers or we are tax collectors working on behalf of. How one would wish, today there is a talk about 7th pay commission final recommendation, whether it will be 36% or 20%. Right? One would wish that I would have would I not be better if I would have been a beneficiary of that 7th pay commission? Instead of contributory to whatever he supposed, the commission would propose. Ultimately, the taxable person, we have seen that input service distributor, the concept has been continued. Section 2, subsection 56 defines term input service distributor practically in the same manner as is been defined under the Rule 2, Sub-Rule M of Senate Credit Rules 2004. Almost. Important thing is input service distributor concept will remain restricted to services, distribution of credit only on services. To 7A and 7B, capital A, capital B of Senate Credit Rules speaks about distribution of credit on inputs by the ISD, distribution of credit by on inputs by, sorry, not ISD, by output service provider. 7B, which has been inserted by this budget only, distribution of credit from the warehouse by of a manufacturer. Both these concepts are missing in the draft model law. The ISD will be only on services. The other part, the ISD has been deemed to be supplier, if you see the definition. An input service distributor is never treated or at par with SSE today. Therefore, the demand cannot be raised against ISD. He is only distributing the credit. But under the new regime, there is an explanation which says that he should be deemed to be supplier. Not only this, and therefore section 17 and 18 provides for the recovery also of the credit which is distributed wrongly or in excess even from the ISD. There is a specific provision of that. The another very important instance, the carelessness of Section 18, speaking about the recovery from ISD, there is an explanation. That explanation defines relevant period for the purpose of Section 17 and 18, which is recovery from ISD. Relevant period is there in 17. Relevant period term is not used at all in Section 18 at all. And it is defined under explanation for the purposes of Section 17 and 18. Coming to returns, I'll just touch upon the return. Another aspect of ISD is also that today there are two specific provisions. ISD credit is attributable to particular unit, it should go to that unit. ISD credit is attributable to more than one unit, but not all the units, then it could go pro rata on those units to which it is attributable. ISD credit is attributable to all the units, then pro rata to all the units. There is a clear distinction between these two, more than one but not all, and all. The current dispensation as per the draft law only speaks about either to particular unit to which it is specifically attributable or more than one unit than pro rata. It does not speak about if it is attributable to all. The point here is more than one will not include all. Ideally, theoretically it should. When I talk about more than one, it is all. But they have made that distinction today. So now we have to presume that more than one means all also. But that distinction is missing, it can create some problems. The other part about ISD, they will be required to obtain separate registration, and coming to returns. The returns which are required to be filed with some deadline. Registered taxable person by 20th of the next month, monthly basis. Registered taxpayer who have opted for composition will be quarterly, 18th of the next month. Filing of return, then the TDS return, the TDS, and come to that, the 10th of the next month. Input service distributor, 13th of the next month. Then outward supply by 10th of the next month. Not applicable to ISD, composition, dealers, and the deductor of the TDS. It is 10th of the next month. Inward supply is 15th of the next month. Annual return by 31st December after the end of the financial year, next financial year. And the final return is to be filed when there is a cancellation of registration or where there is a cancellation order for the registration. Then final return. It just reminded me of final obituary which we write. That I will not let you go without you file my final return also. actually. Other part is section 27, which speaks about this. Friends, bear it in mind, there is a clear provision, there is a concept of valid return. Valid return has been defined, and it says that valid return, if the tax due is not paid as declared in the return, then that will not be treated as a valid return, and therefore the credit of that tax will not be allowable to the recipient. So valid return has been, again, if the non-payment of due as per return, not only that, if the valid return is not filed, then the supplier is also not entitled to utilize the credit. Whatever tax he has collected, which he has passed on, recipient will not get the tax, and supplier himself will also not be able to utilize till the time he discharges his liability. The valuation, MRP based, first observation, MRP based valuation concept will go. As you know, section 4A, retail sale price based assessment in the context of certain specified goods, where transaction value, they have introduced transaction value concept. This is a complete hybrid provision made out of excise, section 4, section 67, Finance Act, and section 14, Customs Act, read with valuation rules. So the transaction value, by and large, the valuation rules are also based in the context of goods in case of on the central excise valuation rules. The point is, there is so much of arbitrariness, so much of intervention which is expected from the revenue officers as far as the valuation is concerned. I'll only touch upon 2 points here. Discount today is allowed if it is known to both the parties prior to or at the time of the removal from the factory or etc. The discount will not form part of the taxable value provided it is shown in the invoice. If it is known at the time of removal or before, or provision of service, discount will not be allowable if it is shown, it is granted by way of a credit note. Credit note has been specifically defined, that insertion of the definition is later on. Debit note has been specifically defined. Document has been specifically defined, ditto from Maharashtra VAT Act. It's a different matter. The Information Technology Act, which has been taken records to for document definition, in the bracket which has been shown 21 of 2000, that actually not a correct law also, Information Technology Act. Because that has already been recited, the new law is in offing. One can, I mean, it is littered with such type of examples. The point here is, if there is a post-supply discount at the end of the year-end discount, quantity discount, turnover discount, performance discount, if that is given, if it is known to the parties beforehand, but it is given at the end of the year, that can be given by credit note, which will not form part of the taxable value. But otherwise, normal discount, unless it is given in the invoice, it will not be allowed. It will have to be shown in the invoice only. Simultaneously, section 53, the amount of GST will also have to be clearly mentioned in section 23A, capital A, will have to be mentioned in the invoice. It is analogous to section 12A of the Central Excise Act, that excise duty which shall form part of the price of the goods shall be clearly mentioned. Again, this terminology, frankly speaking, this terminology hit me for the first time yesterday when I was discussing certain provisions with my dear friend Pari in the year. His contribution is my today's preparation has been immense. Let me publicly acknowledge that. But section 23A, excise duty, the form price, whether tax can form price part of the price, Govindji, that is the issue. We had probably, as Parind was mentioning, that Morarji's judgment. Under weight law, the tax can form part of the price, and the backward calculation can be done. But it will be always advisable, even in the today's context, excise service tax, it is in the, or Swachh Bharat cess, or Krishi Kalyan cess, or some few more cesses which might be in the offing in the coming period, like forest cess, river cess. We may have flood cess, we may have, the Bombay is obviously like a gutter. We can have a gutter cess because it is outside the purview of Swachh Bharat cess, something like that. So in that all has to be shown separately in the invoice. It is always advisable. Again, the point is exclusion and inclusion habits have been are clearly visible in the definition of value, transaction value. We have pure agent concept has been continued. Agent definition includes intermediary. The software industry today headlines, NASSCOM is worried. All Google, Twitter, social media, they are worried because they may fall within the definition of intermediary. And intermediary is agent. And if you are agent, your liability under GST goes on a different planet altogether. Related party, there will be issues and issues and issues. Captive consumption, free supply, business deal between the branch and head office, cost allocation among the group companies. All the issues which are boiling today, seeking the answers may continue, unfortunately, if this is the valuation regime we are talking about. Comparable goods of the like kind and quantity. How are you going to decide? Section 14, Customs Act, and we read with valuation rules. The TDS, I always from the beginning in the context of income tax, and now I am firmed in my saying, I always cause tax, TDS is not only a tax deducted source, it is terror at your doorstep. Section 37, this, where there are the supplies to the government, local government, state government, government agencies, or by the persons as notified by the central government or state government, and that contract supply is exceeding the value of rupees 10 lakhs, then the recipient government or the recipient buyer or the person notified will be required to deduct the tax TDS at 1% of the total value. That 1% will be required to be deposited by 5th of the next month, and certificate will be required to be given by the deductor to the deductee, that is the contractor. That certificate is not given, then there is a penalty of rupees 100 per day of failure, subject to maximum 5,000 rupees. That TDS will be available to the recipient by way of a credit in the electronic cash register. We will have an electronic credit register, electronic debit register, and we will have an electronic cash register. That TDS based on the certificate will be available to the the contractor by way of a credit, because he has discharged that part of the liability under the cash register, and which he can utilize. Whether this TDS can be paid out of the Senvet credit or not, that is ITC or not, no answer to that. By all means, it appears the TDS will be required to be paid in cash only by the deductor. No credit will be allowed to be utilized for the purpose of payment of TDS in the hands of the contractee or the deductor, that is customer or client. And I am expecting this. There are two as other person as may be notified. How many and who will be notified? A matter of educated guess. And in respect of the supplies of goods or services, as may be notified. So two things. Other than government contracts, the other private person may be notified between the private parties, where the one party will be required to deduct, just like jewelry purchase and ornament, gold purchase. And secondly, for the notified supplies, demand and recovery. Section 51. Today, Section 11A Central Excise Act, Section 73 Finance Act, Section 28 Customs Act provides for the issue of the show-cause notice for the recovery of the duty or service tax short paid or not paid or refund erroneously granted or etc. In two situations. If it is non-evasion cases, if such non-payment etc. is not on account of the willful suppression or misdeclaration or misstatement of facts or fraud or collusion with an intent to evade payment of duty or tax, the normal time limit is today, after this last year, whatever they did, this budget, it is 2 years for excise and customs. For service taxes, it is 30 months. It is linked to the half-yearly return to be filed in service tax, so it is effectively 36 months, 3 years. Excise, it is linked to the return filing, therefore it is again 21 months, monthly, 25 months, so 2 years. Now, and if there is evasion, it is 5 years. These are the standard. And then there is the dilution of the penalty in both the cases. If you paid before issue of show-cause notice, or within 1 month of the show-cause notice, or within 1 month of the adjudication order is passed, etc., etc. It appears that they want to continue with the same regime. There is no doubt. It is all replica of the current provisions. Mercifully with the same type of penalty, 10%, 15% nil penalty, as pointed out, etc., etc. The point is, there is no time limit mentioned for the issue of the show-cause notice itself. There is a time limit for the issue of the order after notice is issued, but there is no time limit for issue of the so cause notice. Subsection 6 of section 79, section 51 speaks about issue of the notice in non-suppression cases. No time limit. Subsection 6 says, finally, subsection 1 is about the issue of the notice. Subsection 6 says, if the order is not passed within 3 years from the date of the actual date of filing of the annual return or due date of filing the actual return, then the adjudication proceedings should be deemed to be concluded. Concluded in whose favor? Again, left to your imagination. The point is, ditto under 5-year time limit. If the adjudication order is not passed within 5 years, September 2015, section 20 of the draft EC law, first law, it spoke about 3 years for the issue of the so cause notice, 1 year for passing the order, and 5 years in suppression cases, and 2 years for passing the order. They are defining within what time limit I should pass the order as a adjudicating authority, but no time limit for issue of the so cause notice. With the deeming conclusion of the adjudication proceeding, can it be said that once the annual return, that 3-year time limit counting from the annual date return is over, you cannot issue so cause notice at all? But that order is to be passed as a part of the adjudication proceeding. Adjudication proceeding in the concurrent manner, if you see, it is from the starting with the lease, that is issue of the so cause notice. It is not that if the assessment order is not passed within certain period, it is deemed to be concluded. And what happens to maintain that time limit? Suppose that on the last day or the day before the expiry of that 3 years period from counting from the annual return, the officer gives me the show cause notice and then passes the order on the next day. Then you go to High Court. I was aghast. We had this problem, unbelievable problem, when the moderate was introduced. Moderate, which was kept to be by the then late Finance Minister, Mr. VP Singh, in the budget when he introduced moderate and central excise tariff and small scale exemption 7.5 lakh. When he introduced, he said, what I am introducing is moderate, modified value added tax, and not MADVAT. He proved to be prophetic. That's a different matter, because the years that follow, the moderate scheme as was envisaged and implemented actually made enough people mad in this country. So it turned out to be a MADVAT scheme. That's a different matter. But initially there was no time limit under Rule 57I of moderate credit rules. It was introduced only on 6/10/1988. It was for the Supreme Court to step in and say whether reasonable time limit should be read into it or not. Absolutely dangerous. This is one provision. I was aghast when I saw that I searched and searched. I did not believe my eyesight, which is fairly good, though I'm wearing the specs. Anyway, coming to the final appeals part, friends, appeal 79 to 83. Today, I will only touch upon one aspect. There are replica time limit of the current dispensation. Only thing is the first appellate authority, it is 3 months, which is right now 60 days. And the second appellate authority is 3 months. Then High Court, then Supreme Court. There is no clear demarcation of powers between the National Tax Tribunal, which is to be the current state. There is no mention about that. There will be a separate National Tax Tribunal whose constitution is likely to be as it is of the state or ITAT, like that only. The National Tax Tribunal, from there, when we go to High Court, in what type of matters, today interpretation of law, exemption notification, valuation, classification are outside the purview of High Court. One has to go directly to Supreme Court. So whether that demarcation is not coming out, what is important is pre-deposit quantum. Today, at the first appellate authority, if the appeal is to be filed, 7.5% of the service tax or excise duty or custom duty is to be deposited, not of any amount of interest, penalty or fine or fee, etc. If it is second authority, tribunal, from commissioner appeal order or directly from commissioner order, if it is directly commissioner order, 7.5%. If it is commissioner appeal order, 10%, that is additional 2.5%. What is now required to be done is, under the CGST law for appeal related issues, CGST, the first appellate authority, it is 10% of the amount in dispute. And amount in dispute is the tax held to be payable, penalty, fine, late fee, everything. So if there is a mandatory penalty levied because of the suppression cases, 100 rupees GST, 100 rupees penalty, 200 rupees, one has to pay 20 rupees, which is at present 7 rupees 50 paisa of 100 rupees. Once you go to second appellate authority under CGST law, then again it speaks about 10%. There is no mention whatever 10% has been paid will be taken into account or not. Coming to SGST, again it refurbishes, it strengthens my belief. What I said was that entire law drafting or the substantial part of law has been hijacked by the draftsman from the VAT authority, state government. Under SGST, one pre-deposit is of the amount of the tax, duty, fine, tax or fine or interest penalty which is admitted, and the balance amount in dispute, 10% of that. Under CGST related appeal proceeding, there is no mention about what is admitted should be also paid. Under SGST related appeal proceeding, first appeal, both. One. Then it says about serious cases, and be serious here, because they have defined what is serious case. This 10%, the departmental authority is empowered to approach the first appellate authority, asking for the more deposit, subject to maximum 50% of the amount in dispute in serious cases. And in serious cases are what? Where the amount of tax involved, dispute involved is 25 crore or more, and where Commissioner GST is of the opinion that department has good case on merits. Now you tell me, which is the case where a revenue officer would say, I have no case at all. Coming to the second, under SGST tribunal appeal, again amount admitted to be paid, balance amount 10%. However, department can again approach the tribunal that look here, my Commissioner GST has already earlier stated that this is a serious case and I have a good case on merits. So you again ask for the deposit more than up to 50%, subject to 10% whatever I have paid. If I am not mistaken, this is directly lifted from the VAT provisions. And what is important, kept it in mind, unlike the today the words are, no appeal shall be entertained if the pre-deposit of 7.5% or 10% made. Here they say, no appeal shall be filed unless the pre-deposit is made. The very filing will not be allowed if the pre-deposit is not made. In the same breath, continue with that is, where the tax dues for the past period, suppose immediate succeeding month or whatever past period is not paid, then the return will not be allowed to be filed for the current period. It will not be treated as a valid return. One. Secondly, all the credit or case which is available will be adjusted first against the past dues, automatically, all system driven. First you clear my past dues. You cannot get away that I am paying my current duty, बाद में वो तो देखा जाएगा. Nothing like that. To be kept in mind, there is a prioritization of the discharge of the liability, specific provision for prioritization of the discharge of liability. The TCS on e-commerce, I'm not going into that. Already the Flipkart and other such companies, there is an aggregator, they have continued with the same thing. Aggregators are already under service tax. The e-commerce also, there is a tax to be collected at source by them. So the virtual portal, all those who are running into the living, breathing, we are all actually into, there is nothing like real. We are not living in the real world. For a moment, if we accept, then all these pains of this GST model law will be eased away. Nothing is real, everything is virtual in this country, particularly social media, we know that. Anyway, that is beside the point. But this virtual, they might come to the reality now because there is a TCS provision introduced, rate to be notified by them, and threshold, section 9, 10 lakhs, section 9 read with, there is a separate schedule for that, schedule 3, which briefs about 10 lakh and 5 lakh. How you see the old habits continue? 10 lakh is the threshold exemption in normal cases, 9 lakh I have to take the registration. Ditto for service provider. Section notification 33 by 2012. 5 lakh for no resistance rate, 4 lakh I have to take the registration. Even if I do not cross 5 lakh or 10 lakh, under northeastern states. Once I have taken the registration, I am required to file the returns. And bear it in mind, section 27 specifically requires that even if there are no transactions of supplies or goods in a particular period, tax period, return will be required to be filed, compulsorily. And no ITC will be allowed to be passed on if there is no valid return. Composition scheme, it is an optional composition scheme. Proposed threshold is 50 lakh rupees as expected. This composition scheme will be allowed to the taxpayer, the person, only at the permission of the commissioner. The first time we are now talking about the permission. As permitted by the commissioner, he will be allowed the to go for the composition scheme. As a composition scheme, this will not be applicable to the people who are actually engaged into interstate supplies. No composition scheme for the interstate supplies. If the registered person has under the same PAN number more than one unit operating, more than one registration, then unless he opts for the composition scheme for all the units, all his registered entities, he will not be allowed to go for composition. He cannot have for one composition, he is another entity under another state, he can continue with a normal scheme. No, he will have to obtain it. So if the one of the entities, registered entities of the same person, having the same PAN number, if he is engaged into interstate supplies, he would not get the composition benefit for any of the other, and he can move out of the composition at any time when he wants to. The last things are, we are not going into that because everything is hazy and unclear, and that is, will there be a dual control by the state and central revenue officers? By all indication, answer appears to be yes. Will there be a dual assessment? Answer appears to be yes. Will there be a double or dual audit? Answer appears to be yes. State government officers are already seeking that 1.5 crore, till 1.5 crore, the audit and assessment should be lied with us, power should lie with us. Beyond that, it should be center. It will be, you call it a double dose, you can call it a double whammy, whatever you may call it. But that appears to be the case. There will be a separate registration which will be required for every person under each state and each union territory where he has the business operations. Keeping in principle, keeping in with the destination-based consumption tax theory. So centralized registration concept, which is in vogue for the service providers, and centralized registration, which has been introduced for the jewelry manufacturers as an exception current budget this year, both will be the thing of the past. Registration will be required to be obtained in every state and every union territory wherever it is required. And works contract, interestingly, has been defined in a manner, the transfer of property in goods involved in the works contract, that phrase is conspicuous by its absence in the works contract definition. World over, under GST world over, EPC contracts or such composite contracts involving the supply of labor and supply of goods are all deemed to be supplies of service. So hopefully the never-ending battle right from 1956, Gannon Dunkerley, 1982, Article 366(29)A, deemed sale, all these things again hopefully will be the thing of the past, where the works contract will be declared, is being declared as a supply of service only. That is extremely important. So the problem will be, what if there is a differential GST tax rate regime for goods and services? I don't even want to think about it. From the beginning, when I started with this, I knew I have actually opened up the Pandora's box. I have opened it before all of you. I don't want to think if it is going to be the differential GST tax rate regime, what will be the chaos. So as I said, it is to call it a masala khichdi could be giving a somewhat credit to it. The whole recipe, the whole basis entirely is, they have not learned anything. As Santayana has clearly said, the people who do not learn from their mistakes are condemned to repeat it. It is all read clearly on the entire draft model law that we are going to repeat the same mistake. They have not learned from the CAG report on the things to be actually kept in mind when from the VAT transition, they have not kept it. And that's why I said, I now finally, I am recalling the words of the president, who retired, Mr. Raghuram, highly learned, exceptional person who just retired from SISTET as a president in Hyderabad, when he was talking on what is actually ailing the adjudication machinery in this country. There he had something to speak about the GST, where he says, ditto the words, very, very illuminating words. When I saw the GST bill, he was talking it in the context of constitutional bill. When I saw the GST bill, it is mind-boggling constitutional complexity. It is neither the exclusive list nor the concurrent list. It is a fourth dimensional animal. It is post-Einstein physics. Heisenberg's uncertainty of quantum mechanics is elementary compared to the complexity of this. Even the political complexity of states and union coming together on a continual basis to ratchet the policy of GST is a huge challenge. It is an economical challenge, it is a political challenge, policy challenge, an administrative challenge, it is an adjudication challenge, so that is the next animal that is waiting to pounce on you, but we have to fight, we have to survive. That's what the president says words were. Again, finally recalling Sijbrain Nosen, that VAT expert, one of the most highly acclaimed international experts, he has divided in one of his papers the entire GST world into three categories: the good, the bad, and the ugly. It would immediately, what will come to the mind is that blockbuster, evergreen Western classics starred by Clint Eastwood, none other than the good, the bad, and the ugly. Many of you must have seen it, not, please see it. Ever classic. He has divided New Zealand, Singapore, Australia, he puts it under the good GST countries. UK, European Union, with plethora of exemptions and exclusion, he puts it into the bad GST world. And Brazil, with the multiple stages still continuing, Brazil was the second country to adopt GST, he puts it under the ugly GST country world. The good, the bad, and the ugly. In fact, the Brazil model is expected to be read by or understood by everybody just to understand why Brazil cannot be followed. But here, we might be one step ahead. We use that word that I am going to be holier than cow. It reminds me probably, as far as the good, bad, and ugly is concerned, we are telling Brazil and we are telling the world at large that I am going to be uglier than thou. You can't just beat me. So friends, this sums up, one can go on and on over on this, but my earnest pleading, my earnest suggestion and request to all of you, don't take this lightly. The bureaucracy in this country are, unfortunately, they are used to have their ways. What has come as a draft, in majority of the cases you will find that it also becomes the final. Professional bodies, the trade and industry will have to take this very seriously. There are certain good aspects. Unfortunately, the bad or worst aspects far outweigh the good aspects. The only people who will have the glee in their voice and the gleam in their eyes will be the tax professionals. And it appears that government is so much worried about our livelihood. In Bhagavad Gita, the Lord Krishna Yogeshwar has given so many wonderful promises. One of them is Yogakshemam Vahamyaham. I am running your livelihood. A sutra which has been hijacked by LIC. Because if I believe in this, I don't need LIC. If I believe in Yogeshwar, then I don't need LIC. But this is a country of hypocrites. So it continues. LIC can proclaim Yogakshemam Vahamyaham with due respect. But for the professionals in this country, it is probably bureaucracy Vahamyaham. I don't even need Yogeshwar. I can tell them, yes, you can take care of others. Here is the government, here is the bureaucracy which is going to take care of me, my livelihood. I don't need it. So, and therefore, I'm sorry I might have opened the Pandora's box. I'll just share There can never be the time. It's my favorite Greek myth. In a couple of minutes, I will just share it with you and conclude my talk today, because nowhere in the past, I have been narrating this beautiful Greek myth, very interesting, behind Pandora's box, almost in majority of my talks. I'm inclined to do it because I feel nowhere in my past time, this myth was so relevant as it is today. Once upon a time, as it happens always in the story, this is a Greek myth, two brothers, Prometheus and Epimetheus, were given a task of distributing different traits and qualities to the different animals of the world. Prometheus stands for the forethought or foresight. Epimetheus stands for the hindsight or afterthought. Both brothers started on their task and started distributing different qualities to the different animals. When it came to the turn of the mankind, they ran out of the stock and they had nothing to give to the man. Now man is the supreme animal of the universe. He needed something extraordinary. So Prometheus went to Zeus and he stole fire from Zeus and gave it to the mankind. Zeus was angry. Prometheus was captured. Zeus was extremely angry. Prometheus was confined to the imprisonment where he was tortured to no end. Every day a vulture would come, eat away his liver, but he had a blessing of the immortality, so he would survive. But his torture continued till he was relieved of that torture as a result of the War of the 12 Labors. That War of 12 Labors is again a different Greek myth associated with this. However, Zeus, the sense of vengeance was still not satisfied. He was so angry, so he summoned all the deities and asked them to create Pandora. Pandora stands for woman. With so due respect to all of you who are sitting here, the hell hath no fury like a woman scorned. That proverb has its roots in this Pandora story. In Gujarati, I can definitely say ke chanchedayeli sri karta chanchedayeli vagan sari. An angry tigress is much better, much preferable than an angry woman. So hell hath no fury like a woman scorned. And she was created. All the deities were summoned and asked them to, they were actually mandated to give something to Pandora. And with that huge jar, Pandora was sent to Epimetheus. And both men, Prometheus knew, sitting in prison, he knew what was in the minds of Zeus. He had cautioned his brother that keep away from Pandora. He had cautioned him. But however, this is a myth, they met each other. And obviously, in a myth, obviously Pandora is beautiful. The human emotions which have been guiding or misguiding the mankind from its inception and will continue to guide for eternity will always remain the same. So on those days also it was a dil hai ke manta nahi. So Epimetheus fell in love with Pandora. They made another caution which his brother has given was never allow Pandora to open the box. This he took seriously. So Epimetheus asked Pandora never to open the box. Now Pandora was a woman. She was asked not to open the box, so she had to open the box. Curiosity killed the cat. This proverb is also said to have an origin in this Greek myth. Pandora opened the box, and outside from the box came out all sorts of evils like strife, famine, drought, crimes, and what not, plagues and everything. Mankind was living an extremely blissful and the happy life till that time. They had never experienced such type of evils. Pandora was afraid. She immediately shut the box when the evil came out. One thing remained inside which could not come out. But mankind suffered because of this misadventure of Pandora for the interminable period of time. And thereafter, again Pandora had a chance to visit that box. She opened that box and the thing which had remained inside came out, and that was hope, Asha. And that is why it is said that when we are in a miserable state of mind, when we are facing difficulties, when we are unhappy, it is the hope which keeps us kicking and alive. My today's discourse on this dark model law, being the first one, I'm so sorry. If it has made you miserable, I'm sure hope will keep you kicking and alive. Thank you very much.
Before we can have the photo and hold up here, thank you Salient for that wonderful exposition. We'll have more from you in the months to come and perhaps years to come, or maybe decades to come about the year. And my heartfelt condolences particularly to the taxpayers. It looks like a doomsday prophecy. And of course, congratulations, your growth plan for the professionals is already drawn by the government. I will request Chirag to propose the happy word.
Thank you, Shailesh bhai. Before I perform the pleasant task, Two announcements. We have the Foundation Day celebration next Thursday, 7 July at the same venue. Mr. Harish Mariwala, Chairman of Marico Limited, shall be delivering the lecture. Second, this lecture shall be uploaded on YouTube. As of now, that supply is not taxable. An ideal GST would have been a GST with seamless flow of credit. As of now, it seems that it's full of restrictions. But as far as Shailesh Bhai's knowledge is concerned, it has always been seamless for our society. Thank you, Shailesh Bhai. I request all present to join me by giving a round loud of applause. Thank you.